It is June 18. I'm Tim Quast with Market Structure Edge, and this is the Edge Live Discussion Group. Thank you for being here. Let me let everybody in. I can barely do 80% of one thing at a time, so bear with me a little bit today. So I'm going to do, as I was saying just before I started recording, I'm going to do this. It'll just be me, just the B team today. So no Brian Wilson for the next few days. Anyway. Okay, so what I want to do, I mentioned this I wrote the notes the last couple of days. Brian and I we have kind of a routine where we swap these back and forth. I should have had that up first, shouldn't I? Okay, bear with me. Okay. And I had mentioned the market is there's a lot of complexity to the market on the one hand, because it's a data network. It's a complex data network that depends on machines for prices, has a lot of scheduled algorithms for large scale institutional money, like you're seeing today, where you have index rebalances and options expirations jammed into the same day. I don't know if anybody's even mentioned it. I hadn't heard anybody say anything this morning, but we can see it in the data. There are massive pattern changes or declines in patterns that occur around these events. So, we know it's a big deal. Plus, that's what the money does. There's so much money is pegged to models, and those models recalibrate on a schedule. And algorithms are scheduled in the market to do what they do, buy and sell. And so, we see all that as demand and supply. The point is, it's very complicated. On the one hand, there's thousands and thousands of pages of regulations. If you go look at you can go do that. Look at the NYSE, the SIBO, the NASDAQ, and see their regulatory filings. They will make filings to do different things. It's happening continuously. And you get an idea of the complexity of the market, but it's at root, there are simple things. And I try to return to those so that we can all navigate them well. I've spent most of my career helping public companies do that. Navigate a market that has gotten increasingly complicated. And so let me see if I can find that and mute that. Bear with me one second here. A friend of hers has a catamaran timeshare. I'm going to just do this. Okay, there. Okay, so here's the point. The thing I want to talk about first is demand and supply. I mean, as I said in the note, so yesterday or today, it was today, that it all comes back to the understanding demand and supply. That's what will help you navigate the market. It's how to look at daily trading ideas. I waded through these today. There was good opportunity in Twist. Twist is actually a corporate customer of ours, and they've implemented a bunch of things that we have explained that one should do today as a public company to improve the probability that you attract and keep passive money. And son of a gun, it has worked pretty well. I mean, market cap is pretty small. There, you'll notice that what we have now, except for Intel, which shot right past the entry range, are pretty small companies. But most of these offered opportunity today to trade. I mean, it's just it's demand supply imbalances, and we know that will manifest at some point. And if you get too caught up in the short run, the intraday is all, to me, the correlations reach zero. And I got that from a high frequency trader, and it bears out. But over a longer 1 to 5 days, you have a better opportunity. But the demand supply principle is the core one, and I just want to spend a little bit of time on this, and then I want to talk about short volume, and then I've got a couple of concluding things here. So, and for you who hear this over and over, apologies. There's the repetition is supposed to be the best form of emphasis. Is that what it is? I can't remember exactly how the saying goes, but I do it for a reason, and it's a good reminder for me too. That you just look at demand and supply. I was noticing in this chip group in particular, a lot of them have had relatively low short volume. You can go look at big tech, and that's the case. Short volume for us is supply. And I'm going to spend a little bit more time on what exactly short volume is, because I think it's the least understood part of the market. I talk about it routinely because I think it's an essential thing to understand about how the market works. It's why it's very difficult to short the market. And when stocks don't do what you expect, oftentimes it comes back to the supply side. And then demand is this 10-point algorithm that meters trade execution data, so we can measure all of the volume and see it behaviorally and know when there is more of it. Generally speaking, when demand is above 5 or better, things tend to do better, and it's cause and effect. So you have good demand, and then you get a little gain out of the stock. Those things tend to follow each other. It's not perfect. It's not a metronome, but it works really well. I was looking at this whole group, some that their equipment, and Marvell is a chip company, but this rising short volume is something that is really manifested. And again, if you look back over time and you compare short volume in some of these chips like Marvell, and here it is down in the 28-30% range, whereas in the broad market, it's 50. What does that mean? I mean, why is it so low? And then you have pounding demand on the demand side. And then, of course, this is price. What does that mean? Well, it generally speaking, I'm kind of blending the two, but demand and supply are the core to producing good returns. If you build a portfolio and you want to do your own thing, keep your portfolio ordered around things that are 5 or better. I mean, it's just the simplest thing in the world to just about ensure that your performance will be better than the markets. If you do that, you're just making sure that you always have excess demand for the things that you own. And then you watch the supply side. Supply will deteriorate returns, and returns have ceased here for Marvell. And that condition may change. But what this is telling us, where there's low short volume, there's more real stuff in it. If there's less artificial supply, short volume is effectively artificial supply. I will explain it. I will walk through the basics again. And the whole market is 50-50. And then you have Marvell and other stocks like this. Let's check Intel. I don't know what Intel says. I didn't look at this. It indicates that there is a higher probability that volume in these stocks is coming from actual owners. There is therefore less of it that is coming from market makers who will create it. And I'll explain that. Yeah, so Intel's is pretty low. Down here, when you're around 40-45%, that's significantly below the market. Down here, 40%, very strong demand. And you look at this and say, could you know that the stock might shoot up today? Well, I don't know if you know, but clearly demand is rising and supply isn't. That's divergence, and there's a good probability that you'd get a gain out of it. It's, Intel's just kind of crazy right now. But you can really see those things at work. I'm going to look at Lam Research here, and the trends that you observe in demand and supply really tell you, how much does a group have left in it? You look at Lam and say, well, it can continue to rise. I mean, it's spent nearly all of the time here at 5 or better. Supply is a little high, but it really dropped off yesterday. It's over 50%. If you backed up, I don't recall. I can't keep them all straight, whether this was one of those that had very low. Yeah, it did. Yeah, back here, around 25%. Very, very low. It's starting to creep up. You start to get up in this 50% range. I don't know what's going to happen. You can't say with any certainty what will come next. Is it going to be a repeat of this where excess supply fee, what if nobody's selling? If the shares are 100% owned and you go to buy them, how is it that you can? If the shares are 100% owned by holders and those holders don't sell because they want to own chips, well, where is it coming from? It's coming from exemptions to Reg SHO, as I've talked about many times. There is Reg SHO Rule 201, the modified or alternative uptick rule implemented in 2011. And it's all part of the rules that grew out of Regulation National Market System. So the SEC wants a continuous auction market. There are always a certain number of shares available to buy. And it's by rule and by regulation. And the market is automated. Under Reg MS, if your trade is between the bid and the offer, a marketable order, and whether it's marketable or a marketable limit order, if it's between the bid and the offer, at the regulatory minimum, that trade must be filled. Well, it's a physical impossibility to guarantee that. There is somehow, for some reason, a global shortage of Turkish figs. Maybe there isn't where you are. Maybe it's just where we are. But I've gone to, I've just happened to be looking for those and cannot find them anywhere. You can go to the spot on the shelf and it says Turkish figs, none anywhere. Maybe it's a Strait of Hormuz consequence. I don't know. But that condition never happens in the stock market. Well, how would that be possible? It's due to the fact that the SEC said we shall have not a periodic auction where you have to buy, that's what specialists ran on the floor of the NYSE was a periodic auction in effect. And there's an opening auction and a closing auction. Though most of the volume occurs in those things, you would think, okay, well, doesn't that tell you something? I mean, if most of the volume occurs in these auctions, why wouldn't you have maybe a bigger auction? Instead everybody's doing the opposite and trading around the clock, which is a continuous auction. Well, it's an oxymoron. There is no such thing. An auction, by definition, is the aggregation of buyers and sellers, right? It's what a mall does. A mall aggregates sellers of stuff and presents a central place for people to come and buy it. Well, that condition doesn't exist like it used to in the stock market because it's a continuous auction. And the market makers said to the SEC, when these rules were promulgated, well, that's impossible. We can't have an automated market where we're required to route orders automatically if they're marketable. It can't be a manual order. Then how do we know we could fill it? How do we know there's going to be a seller? We can't just commit our capital all the time. And so the SEC exempted market makers engaged in buying what's called a two-sided market, a bid and an offer, from having to locate shares to short. They still have to track value at risk. I mean, if you have a short period, there's likely to be a covering period right after it. When they are extended periods, that either the direction of the market is about to change or there's insufficient underlying selling and market makers are having to absorb significant risk, which they would have to offset. On their books, they're just short the stock and they fill trades and they're only in it for fractions of a second. They buy low and sell high, tenths or hundredths of a penny, and that's the model. But it tells us that the market just simply doesn't function. In the real world, Turkish figs may or may not be on the shelf. In the stock market, there will always be at least a certain number of shares to buy or sell because of this. And so that's why this is so important to measure. I mean, if it's the central way that orders get filled, probably we should know that. So that's why it's so important. Can I tell you, are we about to enter another boom stretch like this? Or is it the end of a regime? I don't know. You have to put the whole picture together to sort those things out. But the confluence of demand and supply is very important. And I'm going to pause for just a second before I turn my attention to the next thing. In case there's a question, comments, observations. And feel free to, it's a complicated topic. I have talked to people who are market structure experts about this, and we can spend 2 hours talking about it, and at the end go, because it's a difficult concept. Okay, Brad, let me see if I can get to yours. On the vein of supply and demand, I shared your desk note with your son. He replied back with a comment, nice to know that 50% of the shares I own in the market are not real. I replied, it's not really like that, more like using your credit card to buy stuff at Costco. I was at Costco yesterday. At some point, you need to square up your credit card with real money, but for a few days, you can get groceries without using real money. Yeah, well, they have T plus 35. They have 36 trading days to square the books, but it could be value at risk. I mean, if in a model, Citadel is going to roughly, I'm using Citadel like Kleenex. I'm just saying that the principal proprietary traders will be half long and half short, let's say. So let's say there are a bunch of orders to fill for Lam Research. And so Citadel shorts 100% of their order flow to fill those trades. On its books, it's going to have something that offsets that. Could they buy puts on the stocks? Well, yeah. I mean, you could do all kinds of things to square the value at risk. And at some point, because you would end up with incorrect share counts, and it's happened in proxy contests. I can think of one in particular, Procter and Gamble, a proxy a battle with an activist. The share count was wrong because they did not account for short volume. and the outcome turned out to be different than everybody thought because they had miscounted. So you can end up with, this is how you end up with 130% of total outstanding shares. It's because there can be a sufficient credit component. And you're absolutely right that in the set, it's not that it's fake per se. It is a means for the market to function. Do I think it's good that there is a functioning characteristic of the market that is illegal for you and me? Well, I don't think that's a great idea, but it's what we've got. You and I cannot naked short stocks. It's illegal. If a broker does that, permits you to borrow stock that they're unable to locate, they could be barred from the securities industry. It's against the law. But if that same broker is making bids and offers, they're permitted to naked short it. You can go look it up. I point this out all the time that you can. I do it on the fly, but I'll probably can't find it. It's short volume. SEC documents about short volume, where when market makers are engaged in bona fide market making, they can do these things, and it's critical because the market wouldn't work without it. I mean, prices would gyrate, your trades wouldn't fill. And so it's very important. It is like a credit card. I think it is interesting that we have come to rely very heavily on it. I mean, you back up to, pre-Reg MS, this didn't exist. There was no short volume like this. There was only shorting, like short interest. Short interest is shares that have been borrowed legitimately, sold, and not yet covered. Well, it's less than 2% of the float, whereas half of the volume at any given time is short. And so we carefully watch those trends. I will show you two things that really highlight how important it is to watch that trend. And anyway, so did I answered that question? Was there another one in there that I missed? Let me see. David, you were writing. Okay, Candace, how does this created stock supply make it so volatility is lower? Yeah, okay. You've said before that it might be up down 10% per day if the system wasn't implemented. Yeah. I mean, if a market maker couldn't cross the spread between a bid and an offer, that's what they do. So what that term means is somebody wants to sell stock for $20 and 1 penny, and somebody wants to buy it for $20. So there's a penny spread. Well, a market maker will buy it for, call it, 20 and a half penny, and turn around and sell it to the buyer for 20 and a third penny. So taking a piece from each side. That's what they'll try to do. And if it's borrowed, then all I need is a third of a penny to go back and cover it, right? That's how the whole market works. And it's $1.1 trillion of notional value. So if that didn't exist, the prices would have to move much more in our very illiquid market in order for anyone to become a seller. Instead of moving less than a penny, a price might have to move $1 before a buyer or seller would be willing to part with shares. So volatility would explode. On the other hand, what that would force us to do is to have an auction where you find out, okay, what price do a buyer and seller meet? In the stock market, buyers and sellers never meet at the same price, in effect. It's the opposite of how it works in the real world, where if you and I go into a store and we buy something, we pay the price that the seller has on that item, unless it's a farmer's market and you can negotiate. So that's what would happen. Okay, Brad, if we take LRCX, does that mean there are more shares sold than the number of shares issued by the company? Certainly could be the case. Absolutely, it could be the case. There are times when we have tracked on a single day the entirety of the float of a company turnover. And well, how's that even possible? when 100% of the stock is owned by holders. And now maybe 100% of the holders sold. Well, that just, it really never happens. And it's because the same shares trade over and over. And that can only happen because of exemptions from Reg SHO Rule 203B2. Well, 203B2 outlines the exemptions, the ways in which market makers can do that. Yes, that could absolutely happen. The new Fed chair and his proposed change. Yeah, I will. I've mentioned, I can't say I know Kevin Warsh, but in my inbox, I probably have, 30, 40 emails I've traded with him over the years. We have, I think, somewhat similarly, and I traded notes with him right before his nomination. I was happy to see that he's the guy. But we'll come back to that. Okay. David, did I answer your question? I don't think I got your question. Okay, feel free to interrupt me. The core takeaway is volume is very elastic. And so, if you expect that you can short something, you have to take into account that a machine could undermine that. It's why a lot of the short sellers have gone away. Andrew Left he's been indicted and by the Justice Department. He's a short seller, and I just can't. I don't think he did anything wrong. I just think it's very, very difficult to be a short seller today. Jim Chanos, one of the famous short sellers, came out of, I think, Julian Robertson. Out of the whole Tiger management, one of the seminal players in the hedge fund business, out of which came all the Tiger Cubs, and one of the great short sellers ever. And he shut his fund down, and they will all lament, well, why can't you short the market? Well, there's the answer. I mean, if the supply side can just expand to fulfill demand, you have a very difficult time playing turns. You can, and I do it, right? I've explained this before, that when demand and supply do this in the market, if this stops rising, well, I'm probably going to short that because I know that this is a turning point, but there's only so much that you can make. You need them to be moving together. If demand just falls, you get no gain. It's 60 basis points positive when demand is declining. But if supply rises, it's a different factor because now somebody has exposure from a value at risk perspective to 90% of market cap, and they're going to remedy it. And so what is the probability that the market declines? Well, it's pretty high, right? But it only happens periodically. And if you don't know that, then you are very likely to be run over by a truck called the market that you cannot, it has a capacity to absorb almost anything. And you just have to be aware of that. The other thing I wanted to show you in the same vein, that's number one. And the other one is SPY. Have you been watching SPY? I mean, it's one of the things we say, broad sentiment, understand the big picture. Where are we on the arc of waxing and waning demand and supply? And context, what is occurring? The market is not just start over every day, go like a game of Monopoly. It is a continuum. And what is occurring now? Indexes are rebound. I'll tell you why I think it might not be great. I'll give you the answer to that if I don't forget at the end. But look at this. You could back up. I have to back up 3 years to show how abnormal things have been. Normally, you will periodically get a breakdown in what is most of the time 5. SPY is a large cap blend proxy, meaning it's value and growth. If growth is momentum and bounces to 10 and value goes from 1 to 5, right? Value isn't a great bet. And you put them together, what would you get? 5, right? You would get 5 most of the time. And you have periods of excess demand and you have periods of insufficient demand. And those things tend to run in predictable cycles. Well, this one has been the longest ever. And now it's broken down. Well, it's very close to the longest ever. It's right in there. Like we've gone 60 weeks, and we're pretty close to that here. And it's broken down. And now if you zoom back in, just so we can look at this more closely, over if you looked at that over that continuum, you wouldn't see anything particular about the supply side because it's really quite low. I mean, there's less short volume in SPY than there are in the stocks comprising it. And there was a lot of covering in here. But this move against weak demand, to me, since it's a proxy for the S&P 500, is not a great sign. Now, it might heal itself and return to 5, or the market could be headed for trouble. I'd look at that and say it hasn't done that in well more than a year. It's something that we should be aware of. It's just a warning sign that you look at and go, okay, that's why I'm not back in the model portfolio. I want to get past this period because there are too many signs that say, one should beware of these challenges. But they both matter, the supply side and the demand side. Okay, so Kevin Warsh really quickly. And then I don't want to forget the thing that occurred. I actually wrote about it. To me, what Kevin Warsh is saying is when he says we will deliver stable prices, what he is saying is that he is working toward a no inflation environment. That's what he's after. He doesn't want 2%, even though he mentioned it. When he says stable prices, what we have for two generations, interpreted that to mean is that prices rise 2% at least. I mean, if you look at the whole data set, it's not 2%, it's over 3%. The Minneapolis Fed data show that from the formation of the Fed, 1913 to present, inflation has averaged about 3.5, 3.6%. And so but that's not stable prices, that's rising prices. I think that he's very much after no inflation. And as he said, inflation is a choice. I've always said that. Inflation is always and everywhere a monetary phenomenon that reflects the supply of money. So the government creates inflation by expanding the supply of money faster than output. Why would they do that? Because it's very easy to measure growth that way. We want a growing economy. And it enables the government to run up substantial debt. And I think he wants to bring all those things to heel. He doesn't want the Fed to be driving everything. As he said, it would be better if the markets can figure out the data on their own and figure out where rates should be on their own and stop worrying about what the Fed thinks of those things. The Fed should just be focused on stable money, in my view. You focus on stable currency, and then demand and supply can do their thing. Technology should improve productivity and bring prices down over time. That's what happened throughout human history until this era of inflation. So I think that's going to change. We'll see. I'm for it. I would love for us all to have greater security in retirement, knowing that our money isn't going to lose 2% of its value year upon year, no matter what you do. And can you ever offset it? If money has stable value, we stop worrying about tomorrow. And that would be to me, that would be a major advance. We'll see. So the last thing, the look ahead is, so I mentioned this in the note. Yesterday, believe it or not, again, it all depends on your measure, doesn't it? Like, what's your measure of inflation? What's your measure of productivity? What is your measure of economic output? So if you're measuring how stocks behaved relative to midpoint in the S&P 500, yesterday was the worst day of the year. The stocks closed 1.1% below the midpoint. I mean, it's kind of astonishing. It's only happened 2 other times all year. And we've had some pretty rugged days in the market. If you run a year-to-date look at the SPY here versus the composite demand and supply in the stocks, I mean, we've had some tough periods. And yet throughout this, only February 10, I want to say, February 10, down 1% below intraday midpoint. And June 10, stocks down 1% below midpoint. Yesterday was the worst. Those are the three, only 3 times. 2 of them occurred in the last week. Demand's not great. Supply is rising. S&P is below, or SPY is below 5. If you look across the market, you go look at the core drivers of the market. I'm just saying that you could come up with a reason why the market is off to the moon. And but then you look at these data points and you go, well, I don't know about that. You look at big tech. I mean, demand's starting to improve, but it's woeful, right? That's not good. You go look at the tech sector. Again, very weak demand, very rapidly rising supply. And this is half the market. Right? If you add up tech, the tech that's in communication services and in consumer discretionary, it's more than that. I mean, 10 stocks are pretty close to 50% of the market, 47%, something like that. 20 are 55%. That 140 up here, mega caps, 85% of all market cap. And kind of, its demand's fine. I don't see any problem with that, but the supply side is an issue. And so I look at all those things, the fact that stocks closed below the midpoint, and I think it indicates that people may be slowing their allocations to equities because people are looking and go, I don't know, the chips are just crazy. And I think it has an effect. Now, I don't know what's going to happen. We'll see what happens, right? We will see if that, as the data change, then we change our posture very much like, we should do with economic data or, financial data and business performance. You get data and well, we need to address this. That's what we do. But those are things I'm looking at. I mean, the data have been awesome in telling us exactly what to do. They tell us when we should be in the market. They tell us when we should be more cautious, usually in here. Then supply plunged. So we didn't have great demand, but the market took off because of declining supply. That condition at present has changed. Now, I don't know, it may revert again. But right now, you would say, well, these conditions are unlikely to produce that because it's a different condition. And so it always gives us a look ahead to see. All right, I went a little bit long there. Anything else? Let me check here. Tim Conklin, let's see. Oh, yeah, I did that. Okay, I think I did that. Okay. All right, Brad. When you used to fly a lot for work, there were many times I used to do that too. Show up the gate and the agent would announce that the flight was oversold and there were a few volunteers. The airline was selling more seats than what existed. Yeah. Typically only a few seats, nowhere near 50%. Yeah, I agree. It's hard to imagine that 50% of the market, but it requires that much. I mean, it's just remarkable, right? You can go look at KLA, which just split its stock 10 for 1. And it's a longtime customer of ours, a data customer. We supply quantitative buyback data to their treasury department, among other things. And they're trading 450,000 times a day. They've traded almost 1 million times in the last 30 days. It's a staggering amount. And yet, half of it is short volume because now the spreads have narrowed. Like the quantity, I'm not opposed to it. It makes it easier for BlackRock, Vanguard, and State Street to buy it. It's probably the right thing to do. But wow, is it a lot of activity? And it's all automated. And so automated things just run and run and run, and the number of public companies isn't increasing. By the way, I traded notes with Jay Ritter at University of Florida, who's the king of IPO data. And I said to him, it looks to me like not a single IPO in the last year is trading above its its closing day price. And he said, if you look at the data, Medline is trading above its IPO price, but not above its closing price that day. Not a single one. And he said, I don't see, I think that SpaceX will be trading below its IPO price a year from now. And I said, I don't think it'll take that long. And the problem isn't SpaceX or the opportunity. It is that the market does not work for IPOs. Why? Because passive money has to have data. It needs the absence of tracking errors and predictable standard deviation. And short volume plays a core role in creating that predictability. And it needs reference prices. And IPOs are inhospitable. So by the time they accumulate enough data, no one wants them. I don't know why anyone would go public today. I mean, I think if you're private equity, you should sell your portfolio companies to public companies who use equity to buy them. That's how you should allocate capital. Become a feeder chain, a feeder system for private equity, and create more product for BlackRock to consume. Because we'll see that, right? What do we do with the focused passive model? We go where passive money goes and where there's a divergence between demand and supply. Let's see. I'm sorry. Yeah, market makers are in the order flow business, not the stock trading. Exactly right. Citadel is in the business of facilitating transactions, but taking pieces of it. And they're not altruistic. They're not creating, they call themselves liquidity providers. No, they're after breaking trades into tiny pieces so the risk is very small and taking a piece of it. It's a very good business, which does not exist in digital wallets. Now you have to change the prices. You're not intermediating. And if the market goes that way, where does the market making model go? Well, I think that's a ways off, but I'm sure we'll have conversations. Okay, way too much for today. Let's just keeping it simple, demand and supply. If you have your hands around demand and supply and where we are on the continuum, you will always know if you're fine or not. Okay, we'll do it again next week.